Okay, good evening, everybody, or good afternoon if you're in the Pacific time zone, as I am. And welcome to the Option Professor report that I'm going to do. Quick background on myself for those of you who are not familiar with me. I'm Jim, the Option Professor, graduate of Boston College, and have been in the options business for many, many decades. I've conducted hundreds of seminars throughout the country and Canada for thousands upon thousands of investors, teaching them how options work. I've also been to the Options Institute in Chicago for advanced option training, and I've traded thousands of contracts myself. So I'm qualified to explain the uses and risks of options, and that's what I'm going to do for you right now. Now, what I use to determine market direction is not as, shall we say, state of the art as many of the things you've been hearing, I guess, in the last few days with regards to software and many different ways of figuring out whether things are going up or down. I rely quite a bit on moving averages. After decades and decades, I'm obviously familiar with all the different indicators that are out there, from Bollinger Bands all the way down. But I have found that I trust these indicators that I use. I know how to interpret the ones that I use, and they're based on price and time, which is really not negotiable. In other words, it's if it's a 10-day moving average, it's 10 days divided by 10, and then you take the last one off, put the new one on, it goes on. So again, I like to use the moving averages, and I also like to use relative strength because the two things that are most important to me is what's the direction of the market and what is the speed of the market. And if I can determine those two things, I am very, very happy. So up here on your screen, you've got the S&P 500 and you've got my different lines. People go, why do you use bar chart? I like it because it's got a white background and I can see my colored lines very easily. And that's all I really need to do with bar chart. So no magic wand, except that I like the way it looks. It's very easy for me to recognize things and I'm comfortable with it, right? So we've got a short-term average 12, then 24, 36, 120, and 250. My interpretation of these averages are as follows. When the red line makes a turn, that means the trend is turning. And when the green and the blue are going in that direction, it means we're probably going on a long run. Purple is a reversion to the mean level, and gold is a severe reversion to the mean. And so those are what they call longer term averages. And they're very significant to me because when we go to those levels, it's an area where it could be a good place to buy or sell, or it could be a great place to buy or sell, or it could be a place where the trend is totally changing on you. So that's basically some of the things that I use these averages for. And then, of course, when they're coming together, I find that to be an intriguing relationship because when you've got different time frame of averages all at the same price, that's weird. And as I told people, weird doesn't last. So it's a good time for me to go in there. Now, again, what I do here is I go and find low priced options. So I know how all the strategies work, iron condor, butterflies, naked selling. I know how they all work, but I am focusing on the low priced options because my feeling is this. When you're writing the options, obviously the risk can be greater. And so you need a more substantial amount of money to handle drawdowns because when you're wrong on the sell side, it can be an extremely expensive place. So you need to have funds to back that risk up. When you're doing the buying of low priced options, the risk is identifiable and it can fit very well into the risk capital part of your bucket. And that means, again, you can have leverage, you can have limited risk, and then, of course, you can have a very substantial gain if you get volatility going your way. But your risk is going to be limited to the premium, which, if it's only between 100 and 300 bucks, is not exactly off the chart cash risk. So that's why I try to focus on that. And that's why people come to me because I think we do a pretty good job on identifying some of these. And I'll show you how in a minute. So we get the idea here on what's the story with the S&P as far as the chart's concerned. I'm going to give you a quick review on the different markets going on in the world Then I'm going to show you a little bit about how I identified, and here's a list of some of the big movers we've had in the last few months, where the option prices are right here, 287, 255, 325, 296, 241. And then the intrinsic value of the call options before the option expired was as high as this. So that's very big premium expansion on many, many of these things in the last few months. They don't all work this way, but when they work this way, they can go a long way. I'm sure you guys, if you've watched the markets, know these names and you know how big of a move they can make. Also, some of the options are as cheap as 85 bucks, 164, 134. Again, very low priced options because that's your maximum risk. And then, of course, can you make any money on them? If you get a move and they go in the money for you, there's a substantial potential gain. So again, we'll get into that in just a little bit after I have gone through some of the information. Okay? So that's going to be a little bit later in the broadcast. Definitely stick around and learn how we did that. All right, let me show you what I think's going on in the world. The S&P 500. You know, when I look at anything, I always look at the long-term chart. That tells me we're in the ozone because this is the highest it's ever been in the history of mankind. And of course, there's a risk of reversion to the mean. So a big reversion could take you down to 6,200, right where those former highs were. And don't kid yourself, that can happen at some point if the news were to change. And that would be the logical place for a substantial correction to go down to, which is only like 600 points. So it's not like, it's 10% correction, right? So it's not off the charts or anything like that. So if you're going to get a garden variety 10% correction, that's the number you're going to go to right there, the former highs, 61, 6,200, whatever. Okay. And then, of course, if you got the full Monty, like we got in April, right, when he was, everyone thought the world was coming into an end because we were supposed to have 500% tariffs, right? Remember him on the lawn with the big chart? Look what Taiwan did to us. Look what Vietnam did to us. Okay, well, that obviously was thrown out. And once it got thrown out, but look, it went right down to my line here. So when the whole world thought the world was coming to an end, I was telling people two things. Buy the heck out of this thing. Why? Because you're hitting my blue line and it's the former high from 2021, 2022, 4,800, 4,800 plus the blue line. What am I going to sell? This is an uptrend. This is not a downtrend. This is an uptrend. When you get a big pullback like this is just a reversion to the mean. So if we ever go down to 6,200, don't forget you're in a bull market. If we ever go down to the green line here, which comes in at, what does it come in at? Let's see where it comes in at. Come on, cursor, help me. Well, you can see the green line. There you go. The green line comes in at about 5,700 and the other one's at about 5,200. Okay. Those are long term, right? On the shorter term here, you came down to the red line a bunch of times, right? So what does that mean? Come down there, reversion to the mean, and they can't crack it. You've known they can't crack this thing since April. They haven't cracked it. They brought it down like 1 day, 2 day, 3 day, whatever. So again, you know, that's a trend line you could have been following all the way up and should still be following, but we could have a correction down to it. And that comes in more in the area of let's see what you got here. More in the area of let's call it the red line is coming around 66.50, right? Not that far away. We just went down to 67.50. And then if you notice why we stopped there, you've got it right here, 6,700, right? So this is the support, and that's your former high. So that's why, and there's a gap there, right? So that's why it's finding support here. And the RSI is turning up. That's not bad. And on the 1 month graph, it almost came down to the penny, to the purple, which comes in around 67.60. Now, obviously, these numbers, these things pointing down is not good. So you got to get back above 68.60 to turn these things back up. So right now, you're not out of the woods yet. As you can see, we rallied today and then we faded at the end. Got to get above that 68.60 on the S&P. There's a gap there to be filled too. Looks like there's another gap up here, 6,900. Here's a 30-minute graph. Obviously, like I told you, you get above 68.30, 68.60, you're back on the bicycle. So that's when you'll have the get out of jail free card that we're in right now. Now, again, a couple of things that I look at that have been very helpful is the VIX. Like I said, I've been doing this for a decade, so I know how to read these things. On the VIX, you look at this is the 2 hour graph. The VIX is in an upward trend right now. That's dangerous. Why is that dangerous? Because here, when it was so great coming back down off of that 29 pop we had about 2 weeks ago, okay, it starts behaving. You got to buy, right? But it's not behaving right now. It did pull back today down to 17, which is great, but it closed above 18, which is the blue line. And if you start seeing 19 or 20 and it starts going up here, you're going to get a correction and it's going to be a good one. So right now, we definitely want the VIX to stay under this 20 area and preferably go into the 16, 15 area, which means these people have all quit. And when they all quit, that means the family office money and the institutional money will be more comfortable coming in. They're not coming in if the VIX goes to 22 or 24. And that is going to cause what they call a buyer's boycott. And that's what happened over here. When the VIX jumps up like this, buyers boycott and you get a nice big correction because big money does not want to be putting money into something that is extremely volatile. They want it to be orderly. This is not orderly. And if we pop up here, it won't be orderly. So for me, pretty simple. You're in good shape right now because again, your moving averages held and your VIX has not been able to hold above 20, just like it couldn't hold above 20 here. And this thing here was just nonsense. It was like a 1 day nonsense. But again, this 20 number, can you see? It's important. You start closing above it and it starts matriculating up. You're going to break. And what are you going to break again? Let's take a look. Hold on. SPX will come back up. And where are you going to break? You're going to break probably to 67 area. And then you could drop pretty fast down to 6,400. And then, of course, if you want to get the full one, remember I told you 6,200, 6,100, this neighborhood here where the former highs were? Okay, that would be the neighborhood where you could drop to. So you got to be careful, you got to watch it, and you got to be, vigilant. But right now, it looks like the garden variety pullback. Right now, if it starts taking out 68.60, it looks like you'd be out of the woods at that point. And you get that VIX under 16, then you're out of the woods and you could really start going into year end. Other than that, like I told people in the alerts that I send out, the first 2 weeks of November are going to be kind of rocky possibly. And so you want to have less exposure, right? And have powder dry. Because if it goes down to 6,400 and you have a big exposure at 6,900, you're not going to be very happy. And you're probably not going to take advantage of the good price. So that's why, sometimes you just watch, it's called trading options for a reason, right? You have your positions going, you're monitoring them, right? If you think there could be a bigger correction, maybe you pull back. Then you're holding on to some base positions, but you've got plenty of money if there's a drop to do some buying. And then, of course, if it takes off to 6,860 and starts taking 6,900 out or something like that, you could always reload more on what you haven't sold and add to winning positions. So you want to be flexible. You don't want to be in a situation where, if it goes down for 2 weeks, you're totally gone. That's no place to be. So be flexible. The other thing I keep an eye on is the market breadth. And that's going to be very important to go positive here because you know what? I was just reading some stuff that's pretty scary as far as concentration of equity. Do you know in Hong Kong, 6 stocks contributed to 50% of the Hang Seng advance? In Korea, 2 stocks, 40% of the index return. Taiwan, 1 stock, 50%. And so you're talking about, a high concentration, and that can always be dangerous. I keep an eye on this. See, this thing is the breadth, and you can see it started to break. That's why it's got to hold here, because if this breadth goes down further underneath 50 here, then we're probably going to have a real problem. Because again, this is the percentage of stocks above their 200-day average. If you look on a 5-year basis, again, this looks like a head and shoulders bottom. So you know what that looks like to me? It looks like this percentage of stocks that are going to get above their 200-day average could start soaring. because that percentage could go from 50 to 70 or 80. And if we go and have that Tom Lee rally to 7,500, that's what it's going to look like. And that'll be confirming the rally because that'll be the spreading out of the market, right? The percentage of stocks above their 200-day average. So this is key because if you ever break under 45 here, you can see this is a weekly going back to 2021. You see what happened in 2021 and 2022? You know, that's how you get a big drop in the market if this stuff really goes negative. But that's not the case. Not the case right now. So we don't want to be talking about things that might happen because they haven't happened. We want to talk about things that are happening and where's the evidence. Right now, the evidence is you got my moving averages under the price. That's bullish. And if you break above 65 here, there's nothing holding it. So again, keep an eye on the percentage of stocks above the 200-day moving average, because if we take out 60 and start going up there, you're going to have a 7,000 handle on the S&P. Conversely, if you start taking out 50 and 45, who knows that we're not going to start this thing in 2026. So that's why you've got to keep an eye on things. And again, between the VIX and the percentage of stocks above their 200-day average, that's how I kind of read the meter. Let's go back and see one other thing here right now on the S&P. And as the S&P goes, so does the Qs and so goes the NASDAQ, only at different speeds. Um, the RSI right now. Okay, let's see if it's telling us anything. On the 1 month graph, the RSI has had its correction and it looks like it's trading right now at around 50, a little under. So getting that back above 50, again, if you start getting above 68.60, the RSI will get back above 50 and you'll be back on the boat. Here you had RSIs up here in the 70s, right? And up here, the RSIs in the 60s. So obviously that's called a divergence. That means it's running out of steam, and that's why we've had the pullback. Right now, the pullback on RSI is holding 50. So that's not a bad thing. Okay, holding 50 RSI, holding the blue line, positive. Holding the support level on the percentage of stocks above the 200-day average, positive. Not being able to sustain a 20 VIX or better, a positive. These are all positives, but again, positives can change, and that's why you have to stay on top of things and not go asleep at the wheel. And then adjust your positions accordingly. Again, people have a hard time understanding. It's okay to come out of something and go back in it at a higher price, because if you go back in it at the higher price with a conviction that it's on its way to even higher prices, that is not a bad thing, because you're not going to make money if you hold on to things and then they go down. So you really have to make sure that you're on the train that's headed north. And if you're not certain, it's better if you're in New York, it might be better to get into the train in Connecticut, one state north, if it's going to Maine, then get into the north train in New York and find out it's headed to Florida. That's a little bit of an analogy for you. Okay, so there you go with the S&P, and there you go with how I'm trying to read it. And so basically, like I say, got to be bullish, got to be looking good. But these next 2 weeks, this week and next, could be spotty. And don't forget, we do have the big kahuna coming up on the 19th. And who is that? That is the NVIDIA earnings. So again, one of the problems again is that the AI trade has got the margins. The AI trade has got the capital coming into it. The other 493 stocks have got to do a little bit better. That would make the breadth thing turn up. So if we have a good Christmas deal, we have a good Black Friday, if we get some kind of positive vibe going, then of course that could be good, because the Fed put a little water on the interest rate picture, and that's what I'm going to get into right now. What's going on with the interest rates? Well, I'll tell you what's going on. I've been as clear as a bell on this. I was not surprised at all that he said that's not a definite cut in December. I mean, come on, you got 96% of the people have a job. Their wages are not dropping, they're actually increasing. Maybe they're not increasing fabulously, but they're increasing, right? So they're working, their assets have been rising, right? And the GDP is growing, and stimulus is coming through the beautiful bill. Don't forget, these companies can write off all this money 100% first year. Why do you think they're spending all that money? They're probably looking at it as like, hey, we either pay tax on it or spend it. Let's spend it, you know? And then, everyone's going to get this big refund check. That's going to be stimulative. And then, of course, they stopped doing QT, which means there's no quantitative tightening after December 1st. That is another form of easing, plus the quarter point. So you got some stuff that's a bit of a tailwind here. Now, that's why I didn't think the rates were going to drop very much. And so far, he cut rates, and look what the 10-year note's doing. The yield is rising. It's gone from 395 to 415. That's a 20-point jump in yields after a cut. Now, I've been using the 20-year graph to give me my big picture. And here's why. There's been two times in the last couple of years where people thought rates were going to definitely drop. Well, one was when he cut 50 basis points back in September. And can you see this is my cursor on October? What happened right after he cut 50 basis points? Well, the yield went all the way up to 480, went up 100 basis points. He cut 50 and went up 100. Now, when's the next time? Well, when Trump had everybody thinking, he's going to go with 500% tariffs and the stock market was collapsing and the yield went to 388. Now, the yield was 360 here, 388 here, right? And then what happened after he called the dogs off? Well, the yields went right back up again. And notice these moving averages haven't crossed and they haven't pointed down. So I think it can go to 3% interest, no doubt about it. But it's not going to do that unless it breaks 388, which is the lows from April. And can you see they just tried to do that and they failed? So I'm thinking that if this thing starts breaking above where the blue line is, which comes in where, let's get this cursor to work for me here. It comes in at around, let's call it 414, and let's call the top end 430. So if you break above, and you're above 414, so if you break above 430 and these things start going up, imagine if we went to 450 or 5% yield. Are you trying to tell me the stock market has already factored that in? Absolutely not. So again, this thing has to break that 388, and then you're home free down to 3% or 340, because the 5-year has supported 340. You see the gold line here? And again, the trend looks like it could break at any moment, except if you looked at the 20-year graph, which has been very helpful. Okay, so that's the story. If you think it's going to drop, how do you play this thing? Here's how you play it. TLT. Now, first of all, I want to show you something on this treasury note before we leave it. Because if you go back here on the 5-year, I guess, and you go back to the last time yields were at this 3% area, you'd have to go back to around September 2022, right around 2022, 2023, 24, 23, I'm sorry. So let's go over to TLT and let me show you what I'm talking about here. This is a classic idea of a cheap option that could get expensive. Now, can you see TLT is having a hell of a time getting above purple, right? And that's the same way that the 10-year yield's having a hell of a time getting underneath 390, isn't it? Right? So we know there's resistance there because the yield can't break 390, and this thing can't break whatever the heck that is. Can't break 91 and a half. Let's call it 92. But if it broke 92 and they broke 390, what would happen to this thing? I think it could go up to 110 almost. Why is that? Because that's the next line of resistance on this thing. And I think it could do that because that represents about 340, 3% yield on the 10-year. If this 20-year would go down like that. So how would you play that? Now, like I say, that doesn't look like it's happening right now. But how would you want to play it if it started to look like that? You go over to the option prices here. And you go to March of next year. And that means you got the rest of this year, the first quarter of next year. And say you bought the 92 calls because it needs to break above 92 or it's no good. Right? It's 175 bucks, 170 bucks. That's total risk, 170 bucks. And if it ever goes up to, say, 108, which is somewhere near where that gold line was, you take 108 minus your 92 and you get $16 in the money. $16 times 100 shares is 1,600 bucks. So your target, if it ever hit 108 between now and the end of the first quarter of next year, would be 170 bucks with the potential of going to 1,600. And that's exactly the kind of thing that I'm looking for. Now, if you want to go further out, you go to June. You want to go out to June? You go out to, let's see what they got here for you. They got a deal for June 30th. What does it cost to do that? Well, 252 bucks. Now you got you got the first half of next year to go up, right? So, there is a barn burner here, possibly, rainmaker here, possibly, if we are going to get rapid rate cuts, which right now is not exactly on the front burner. But don't forget, Trump putting his new guy in there, and he's got orders to do whatever he does. So, if you want a speculative way of trying to take advantage of that happening, that is basically how you could play it. And that's a example of what I kind of look for is something that is not being priced in now because they can't price in something that hasn't happened. Options and all these things are priced on what has happened. I mean, why do you think an option has a big fat price? Because the market has just made a volatile move. And so the implication is it's going to keep going that way. Of course, that's not always the case, is it? So that's why a big fat premium is dangerous from the standpoint of if it goes sideways, you lose. If it goes downward, you lose. And if it goes up on a call that's fat, you might not make any money because as it goes in the money, it loses its time premium and all they give you is intrinsic. So that's why they can't charge a lot for these options about going to 108 because it hadn't happened. And there's no real evidence of it happening. There's a lot of talk of it happening. And that's why the option's cheap. It's like the old thing, people will pay more and more the more real it becomes. So obviously, if we break 92, go to 95, these options are going to be up a lot more than they are now. Of course, depending upon the time. Okay, so that's the big thing. I just gave you stocks. I just gave you the interest rate picture. Both of those obviously should be front and center as far as your interests are concerned about following things. Quick thing on the U.S. dollar. And I've been bullish on the US dollar because I said to people, this is called the double low at 96. This had an RSI of 33 and this had an RSI of 40. So that's a divergence and the red line's turned up and the whole planet is short the dollar. So obviously I'm thinking it's going to go the other way and that's what it's been doing. Now, where is it going to stop? It may stop as quickly as right around here to 101. It could go up to 103. It's not in an uptrend right now. It's having what they call a rebound rally. And if it drops under here, there's nothing. This is what I'm trying to say. If you want to hear about a currency crisis, if we break under 96, we could be having one. Because it could drop to 90 before you can spell the dollar. And that, of course, would be probably very good for gold and Bitcoin because they're alternatives to the dollar, right? Right. So watch the dollar. It found support. It's back above purple. That's a positive. These lines are still pointing down. Probably not going to be easy to get through that neighborhood. Where's that neighborhood? That neighborhood is like 103 towards 101 to 104. Let's call it that. Something like that. That's the story there. Okay, you guys have gold positions on. You want to talk about gold? I've been very good with gold. I'll tell you how I figure it. First of all, you look at the 20-year graph on gold and you're in the ozone, right? A reversion to the mean at some point, right? Okay. Now we go up here and we go in the ozone. Reversion to the mean's already started, right? And then you go to the 1-year graph and what do you got? Reversion to the mean has happened. And it is hugging on for dear life. And I said to everybody, as long as it holds 3,900, you're okay in the gold. You know what I also say? If it breaks, you're going to go down to 3,600 before you can spell gold. So that's why there's a critical zone right here. And you'd love to see it get back above 4,100 if you really think you're going to make any big money on it. because big money is happening above 4,100. That's another example of me. Yeah, I could buy right here and hope it doesn't break, or I could go 4,100 on its way to 4,400. Do you get where I'm coming from? I don't got to be the first guy at the party. I just want to make sure the party's happening. Right now, I can't tell you the party's happening. I could just tell you it's holding, right? So keep an eye on it because that's the story and goal. Bitcoin. A lot of you guys are into Bitcoin. I've been very good on that as well. Let me show you. Again, I look at the 5 year. You see, I don't want spaghetti. I can't figure out what spaghetti does. So basically, I go to where I can smooth out the edges, and here's how I do it. So we get bullish here in 23, right? Then we let it rally. Then it comes back along the line here. All this little penetration of the line, as long as the line's pointing up, this is all baloney. And once it gets above red and blue and green, it's going to fly like it did. So this is a good place to do your buying. Then we had a reversion to the mean, another good place. Again, another baloney trade, right? Once it got back, once the baloney's done and it gets back above it, and then gets above red and then green, you can only do one thing, it's buy. Now we've come back and reverted to the mean, and I don't like the way it broke, but we're at 104 again. So you can see where 104 was my line in the sand. It's back to the resistance because once it breaks, it's now resistance. So it's still looking like it could break. And if it breaks, it's going to shock some people because you can see there's a lot of real estate in here to make, and there's not a lot of people counting on that. On the 1 year graph in Bitcoin, there is nothing underneath it. Everything's above it. That's not good. So that's why I'm trying to say this is holding on for dear life. HODL. And then here you can see why it might stop here because on the longer term one, 102 is an area. So you break under 102 again. Again, hopefully this is a baloney trade. Tom Lee certainly believes it is because he's still talking about 150, 200 Bitcoin by the end of the year. Well, that only happens, I think, if a couple of things happen. The VIX starts breaking under 16, the advanced decline thing starts blowing out 60% or better, and then of course the S&P starts blowing out 7,000. That is the recipe to get this thing going. Okay? And like I say, I'm from the school of if you're going to 150, you got to go through the red line here, and that comes in at around 115, 117. So basically, you're looking at yeah, let's call it 112 to 115 now. Have to start trading above there because you're not going to go to 120, 130 unless you can. And for all you know, the bottom's going to fall out and come down. This thing can get volatile. So anyway, be careful with your Bitcoin stuff. A lot of these stocks, obviously, the ones we've been talking about for years. I mean, come on, we were all over this stuff way down here in the $20 range. I have it in my own personal account down here in the tens. So bottom line is what? This thing had a run. Then it had the retracement. If you wanted to buy it, it came down to $35 right on the red line. Plenty of time to buy it right there. And now it's trying to get back on the bicycle, but again, it's very, very extended here. So, and again, the RSI looks like it's giving up. Other ones, we had this one at I think $10 or something like that, $5 or whatever. Yeah, you see how it was $5 or $10? Iran, look at that. But this thing is, this thing just signed a big deal with a company. I don't have the specifics right in front of me, but they had a big deal about cloud computing. And so obviously it's got great news, but the darn thing has come a long way. Now, it had another big day today after coming down. Somebody asked me at my last webinar, do you think it could go back up? I said, of course it can come back up. You had a correction right here, and you would want to buy it here and get out of it if it broke underneath the blue line. So, getting in at 60, getting out at 55 is not a bad risk. And of course, right now it's $15 up from our meeting, and we had this meeting yesterday. So you can see that it basically, has gone back into the uptrend. But this is lofty stuff. But I mean, that RSI does look like it wants to scream. So that gives you a little bit of the Bitcoin story, and I think that gives you an idea of what I'm saying. Bottom line, you start breaking under 104, 102, 100, this thing's going in the soup. You start breaking above 112, 115, 117, then start bringing the Tom Lee bulls back out. Two stocks that have been whacked and people probably can't understand why. MicroStrategy has been a real dog, but again, the dog may, come up and bark again. But you can see, in my view, you're not going to make big money on MicroStrategy until it gets above 350. And if it does that, and then Bitcoin's going to 150 or 200, you'll make plenty of money. Right now, it's getting close to the support area. This is the former lows. But the RSI on this thing, has not been strengthening. It's been more weakening in the 35 level. So this is definitely weakened. And BMNR, which is your Ethereum, this is another one that has definitely gotten a little weaker than people thought. And so basically, like I say, both of these stocks have one problem right now, among others, and that is that short sellers have been shorting the stock and buying the physical, meaning there's a premium on the price of MicroStrategy and Bitmine higher than the crypto they own. And what people have been doing is selling short the stock and buying the crypto, be it Bitcoin or be it Ethereum, looking for that juice to come out of the orange. And have they been right? Well, you tell me. Looks like they've been very right, right? The guys like Jim Chanos, right? I mean, this stock's gone from 460 down to 250. That's a 200-point drop. And we're looking at we're looking at highs on Bitcoin while this thing's going in the tank. Something doesn't make sense. This Michael Saylor is like the Pope of Bitcoin. But again, they found out that his stuff is trading at a ridiculous premium over the crypto he owns, and they don't want to pay it. They think it's coming out. So that's your story on the Bitcoin, and that's what's going on there. I'd like to look at oil because this could be the sleeper for next year. Everyone's bearish on oil, and rightfully so. The stuff's in a downtrend, right? Look at the 20-year graph. But it's holding on for dear life. But you can see it could go into the abyss if it wants to, if it starts taking out this. But again, look at where my RSI is. 39. Where's it over here? Like 39, 40. When RSI is at 40, only two things are going to happen, in my opinion. It's either going to break 40 and you're going to go into the abyss and the RSI is going to go down to like 20 something, or you're looking at the bottom and that is as low as it's going to get. And the RSI is never going to break 40. And the next thing RSI will be at is 50 or 60. And that would be if we can get above what? Get above 60, get above 70. Then you've got a possibility the whole world changes next year. If that is true, is there anything out there that you could take a shot at? Well, let's look at XLE. XLE on the 20-year. Let's go to the 5-year, easier to read. Right there, listen, remember I told you when all my averages come together, something big is going to happen. Why is that? Let's use our common sense. All the averages are at about the same price of 88. Now look at the time frames, 12, 24, 30. They're totally different time frames. What the heck are they doing at the same price? It's weird. Weird doesn't last. So this baby is going to break down towards 78, or it's going to break up towards 95 sometime in the next 3 to 6 months, and that's going to create an opportunity. If it's going to break to the upside, this index is heavily into two stocks. What's their names? Chevron. You see Chevron's got all the averages pointing up. So if Chevron could break above 160, it could fly. And where would it be going if it does break above 155, 160, get above this 156? There's a gap there, and the gap comes in at 166. So is there a possibility that the purple holds here and that we're going to break up? It's possible. I keep an eye on it because the options are pretty cheap. How cheap are they, Jim? Let's look at them. Let's look at December. Let's look at January. Let's go out of January. It means we got the rest of this year and the first 2 weeks of next year for it to get moving. Well, they're a little high. So let's look at a little less time. Yeah. The 150 calls are going for 575. The 160s are going for 170. Okay. For me, I'd look at the 160s. Why? Because if it goes up to 170, they're going to $10. That's not bad. If they don't, 170 is my maximum exposure. A lot of people are doing something with this one. Look at the volume today. Look at the open interest. So somebody's doing something with this one. If they're writing them, boy, are they writing a small premium. They're going to make 36 bucks and they got 2 months to worry about oil taking off on them. And if they're wrong, just imagine if it goes up to $10. They're going to have to buy it back for 170 and they only sold it for 36 bucks. That's not my game. They call that picking up pennies in front of a steamroller. It's not worth it. Not worth it. In my view. In my view. You'd have to be right all the time because if you're right, 5 times and then the sixth time it goes to 170, you've given it back all the gain. So there's one right there. And the other one that I'm looking at that I think even looks better possibly is ExxonMobil. And on ExxonMobil, you can see, again, if it could get above 116, there's nothing holding it back. If you look at the 5-year graph, can you see? I mean, if you get through 110, this thing is going down. But if you can't get through 110, all of those averages are under the price. So you can see there's also nothing stopping it. So that's why these two stocks are of interest to me because again, they fit into the mantra of what? Cheap options that could move if the volatility picks up. So there you go with energy. And we went over Bitcoin and gold. And then the only other thing before I start getting into how I find these good ideas is to give you a little bit of an idea of the worldly stage. You know, there's a lot of opportunity around the planet. So I follow everything. And so when I start seeing Japan picking up, this year, after this little stupid drop, and I know it's in an uptrend. So I see this as a ridiculous, just like here, this is ridiculous and it's not going to last. So once it got above 66 and go above 67, 68, it's a total buy. And if you don't own any Japan stocks, you're not going to fly over to Tokyo and start figuring out, who sells burgers over here. You get an ETF, and somebody else has done the homework for you. And so basically, that's something that I brought to people's attention in the alert, and that would have been a good idea. Same thing with some of these Chinese stocks. We've had a very good time with Alibaba because Alibaba gave us a great opportunity. I'll put it on the 1-year graph because it's happened then. You see when it was all like in here? Remember what I told you? When all the averages come together, what I tell you? Something big's going to happen. And when all the things together, what the options are going for? Less money. Why are they going for less money? Because no volatility means no implied volatility, which means lower premiums, which means I can play ball for a cheap price and I can go out a couple of months. So if you go out a couple of months like October, like I did, and you get a call a little bit out of the money, like 130, and you pay a little bit of a premium, you can catch a pretty big ride. And if it has a pullback and you want to take another shot, you can catch another ride. Now, right now, it's in a precarious position, but if it gets back above here, which is 175, it won't be precarious position anymore. It'll be back on the horse. Same thing with Baidu. We had good fortune with Baidu as well. Why? Because it was the same thing like Alibaba. The stock was trading at about 100. The 100 calls plus a put went for 255 bucks. When it jumped up here, the intrinsic value of that was not 255 bucks, it was 5 grand. 150 minus 100 is 50 bucks times 100 shares, it's 5 grand. So the risk reward was on this one was obviously fantastic. Now you had the pullback. Now you had a pop. Now it's trying to make a turn possibly here. So if we can take out 130, this thing's back on the bicycle. If it takes out 120, it's going in the soup because there's gaps to be filled. So it's a very critical time for Baidu. And another one here is Mexico. Mexico turned up right when those right when those tariffs came out. That's when it turned up at 52. Then they give you a few opportunities. It just went down a little bit. Now it's breaking out again. So this thing's been a pretty good place to park a little bit of money. And one that has been very bad, I think it's starting to turn a little bit, is India. You see India? having a tough time, but it is starting to look a little bit like it wants to turn up. And Modi is obviously doing a lot with us now with regards to the Russian oil. And this thing here on the 5 year, that looks like a rounded bottom. That looks like it wants to go up. So if I had to say which country looks best right now, bam, India. So again, on the alert each week, not only do I give you ideas, but I also give you a commentary on what's going on in the world through my eyes. And as you can see from what I'm showing you, I'm not picking them out of my ear. I'm using what I know about going on in the world with some technical analysis, trying to follow the trend, try to get on board on reversions to the mean or breakouts. What does that mean? A reversion to the mean would mean on India, you'd get in at 49. That's a reversion to the mean. Or you'd get in as it breaks above 55 because that's a breakout. Those are the two times where I think it's best to play ball. There's a million times you could play ball, but I don't like the odds. And when you're doing options, in case you haven't figured it out, you're playing odds. And somebody's making a mistake. Now, I was a seller of these options in my career a lot of times, decades of it. So I know all about the sell side. I know the premium can go to zero. I know that most options can expire at zero. I know if you buy in options, two out of the three things that can happen are going to be bad for you because sideways could eat up the premium and down is going to be bad on calls. Direct opposite on puts. Go sideways hurts you, up hurts you. I know that. I also know people get whacked hard when they sell options. They get whacked really hard. And when do they get whacked really hard? When they sell low premium right before volatility. So what do you think I do for work? I go look for where I think the options are cheap, the seller's making a big mistake, and he's going to get whacked. And that's why I found those things like Alibaba and Baidu compelling. Not everyone is going to work, but the numbers can work out pretty good as long as you catch some good rides on things and you keep your premium cost down. And not only that, if I buy something that I think is going to move and I give myself 1 or 2 months, I generally are not going to give them 1 or 2 months. I'm going to give them 1 or 2 weeks to show me I did the right thing. If they don't, I don't mind cutting and running. The idea is to cut the things that aren't working out and add to the things that are. So that's why they call it trading options. And I'll give you a couple of ideas on how to do that as well in a second here. But again, we have coaching sessions in what I do. And during the coaching session, people bring me all these ideas they've gotten from all these other services, and we put them through my meat grinder to see what they look like. And at least they get my view on it. Sometimes they've avoided big problems. Other times we've identified that they were good ideas. So during the coaching session, you can get an awful lot of value from it, not only but hearing about what I think on my stuff, but also what you're hearing and on your stuff to try to obviously make you a better trader and hopefully reduce risk and hopefully, get a better result. So there you go on some of the internationals you take a look at. Now I'm going to show you some option prices and options, and I'll explain a little bit about options. If you guys have any questions, let me see. I guess you do have some questions. Let's see what you got here. Hold on. I got to hit the chat box here. What do we got? Okay, yeah. John made a comment. Is Michael Saylor might be selling his own stock and buying Bitcoin? He's probably doing that. Anyway, what if the FOMC does not listen to the new Fed chairman and does not agree to reduce rates? That's what I'm trying to say. That's the whole thing. I tell you right now, the evidence is they're not going to do that because we haven't broken 388. Do you get my point? The whole planet is long bonds. The whole planet is on Bloomberg and CNBC about how rates are going to come down. I've never heard a bigger chorus since I heard the Mormon Tabernacle Choir singing, right? And I've been around long enough to know that there can't be that many geniuses in a room. So who's taking the other side of that trade? So again, without the 388 getting taken out on the downside, I'm not on board with the lower rates. If it does, believe me, I have no problem seeing it go to 3%. No problem. And like I say, we don't know who he's going to put in there or if they're going to be able to play ball. But, and again, they only got the one vote or something. But again, there could be influence. The bottom line is we don't know. The evidence right now says there's no big rate cuts coming until we do that other thing that I talked about. What about other precious metals and industrial metals? Good question. Let's hit them because I did very well with this XME. Look at XME. I mean, talk about a nice year, huh? Started out down here in April after everybody got scared out of the market. Started at 50 bucks, gave you another chance to buy here on the pullback. Pretty much, come on. You just followed a red line all the way up. You had it to 105. Now it's turned over. Now you got to figure out, is it a correction? Well, you got the one inversion. That's not good, meaning red's crossing blue, but blue's not pointing straight down and green's not either. So if this thing got right back above where? Right there, which is 90, probably at about 97, and then back above 100, you're back on the bicycle. But again, this thing's had a big run. Look at the long. See, this is reversion to the mean. This is why you never buy when it's up like that, because it's just too dangerous. First of all, if you're buying calls, you know the calls are going to be enormously fat. So when they have the correction down to 90 and you want to give it a shot, maybe there. Goes down to 80, give it a shot. Has the full Monty correction down to 70, 75. Okay. But, try to buy things on reversions to the mean that are in bull markets. They all revert at some point. Be patient. If they don't, just wave to the people on the cruise boat saying, we missed that boat. We got others to follow. So then that's your story on industrial metals. I thought copper might get going, but that hasn't happened. And Freeport-McMoRan is my proxy for it, but it could still. Yeah, this could be a great time to take your shot on Freeport. You see where it's trading? And the options are cheap. So if this thing's going to get on the bicycle and get back going to 56, just to give you an idea, let's go look at some calls. Let's say it's going to happen between now and the end of the year or January. Let's see what happens by January. 42 calls or 226 bucks. That thing goes up to what? 50? Goes on a $10 run for whatever reason. They're going to go to 8. Am I the only guy with that idea? Well, you got 404 contracts and 11,000 open interest. You want to buy the box seats? Buy the 40s, 320. 19,000 open interest. Because they're going to go. They're going to go if we go. And that gives you to the first 2 weeks of January. So that's a good question, guys. That's a good question. I'm on top of it. I mean, every week I've got a Freeport-McMoRan idea in there for people who like copper. But now it looks like it actually could be a good deal. It's still not out of the woods, but it's definitely held some support and all the averages are converging. So we know something big. I mean, I'll bet you if we had a conversation in the early part of next year, it's either towards 30 or towards 50. I don't think it's going to be the same. Um, And people are saying there's much better crypto going on than Bitcoin. Believe me, there probably is. I'm not an expert at crypto. I basically know about the Bitcoin and I know about the Ethereum. I like the Ethereum because I bought into this concept of stable coins, and Ethereum's going to be used to be the backing of it, the blockchain. So I find that somewhat reasonable in a very unreasonable investment. That's hard to explain to people. Do you have any other questions? Put it up there. And we got a few more. Record homelessness, 35 adult kids living with their parents. Yeah. We got a wealth gap. The guy in New York proved that. I mean, that guy didn't get elected because he's got experience. He's got none. He didn't get elected because he's the most charming man. He's a nice guy. He got elected because he told everybody that the wealth gap is ridiculous and I'm going to help you close it. Now, everyone calls him socialist and communist. Maybe he is, or maybe he's just going to put a little moderation in there where people who don't have a lot of money can maybe get some type of housing. And maybe if you don't make a certain amount of money, they'll let you ride the bus for free. I don't think that's going to kill the world. If he takes it way beyond that, of course, it's problems. But, throwing a few bones at the poor never hurt anybody. And anyway, we'll see. We'll see. Because like I was telling my buddy, he's no longer in Bowdoin University in a theory class. He's in the real world now. So let's see his logistics on turning these wonderful ideas into action. And that's really where we are now. Let's see if we got anything else cooking here now. I don't know that name at all. Okay, so let me proceed and give you some details on how I operate, and then again, what I'm trying to do here, and how I think I can help you. Okay, this is a chart on IBM, and I'll show you basically a couple of times. Now we're going to do the 1 year graph, and there's a whole year of stuff here, right? A whole year of data, and I'm going to show you when 5 times this year I had an interest in IBM. The first time was in January. Why was I interested in IBM then? Because you see, it had a reversion to the mean down to purple, and then all the averages converged, and then they turned up, and the stock started trading above it, and they had earnings coming out. I figured IBM's making money, and I figured the correction was over, and I thought the options were cheap, which they were. Bam. Now, once it goes up, you leave the party. Why do you leave the party? Because the advantage has left the building. What does that mean? That means the options are no longer cheap, they're going to be expensive. The market is no longer down, it's already made a move. And so it's going to be a tougher way to make money. Doesn't mean you can't roll up the position and put a bone out there in case it's going to keep going. I'm just trying to say my personal opinion is hit and run. Second time it was interesting was when Trump had everybody selling out all their stocks back in April. It had a reversion back to the gold area. Now, there, it's very oversold. And like I told you, purple can be a good place to buy, gold can be a great. But here, I don't like the fact that the red is still pointing down and you're trading under purple. I find that a little risky. You could take a shot if you said, Jim, I'm going to buy some calls down here. I wouldn't fight you. But I would say I'm going to wait until red turns up and green turns up at around 230 because then the money might come a little easier. And of course, that's when it did. So that's the second time I thought it was a good deal. Then it was a good deal in August because you've gone up $100 in the price, and my red line turned over, my green line's turning over, and I think it's going to revert to the mean. And what does that mean? It's going to go down to purple, which it tried to hold, or it's going to go down to gold, which it didn't hold. But once it starts trading under gold, and I know I'm dealing in IBM, these guys are in the heart of this AI stuff. I know that this is probably temporary, but once the red it gets above gold and the red and green turn up, then the money is going to be easier to come by. So that's when I was interested in it again. And then, of course, it had a big pullback, very short-lived, but that was your chance. If you want to buy a call on it, that was your chance. And now it's right back into the thick of it again. So that's what I'm kind of looking for. I'm kind of looking for reversions or breakouts. And that's when the options can be less expensive. Because again, I'm looking for sellers that are making a big mistake, which means down here in January, the seller is selling calls after it's already dropped and the trend's turned up. That sounds silly. In May, the stock already had a big tank and now the trend's turning up and you're selling calls on a stock that really is a great stock. And up here, you've gone up $100 a share and the trends are turning down and you're going to sell puts? That means you're agreeing to buy the stock as it's rolling over from a 100 point run. That's why the puts make sense. And down here, you're selling calls on a company that's just went down 160, 70 bucks and the trend's turning up. That sounds silly. So that's what I'm looking for. They're not on every corner. That's why it takes a long time for me to do homework and to find these things. And that's why people subscribe to the letter to obviously take a peek at my homework. Um, to give you a little bit of an idea here, we were going to go over some of the stocks in the last few months and why I would have picked them. So let's look at AbbVie. This is from July. Well, let's start it with June. June, we had, well, I already showed you Iran on June 15th. So what was the price on June 15th? It was about $9, $10. Why? Because I could see it rolling up, and again, it was part of the quantum trade. And so it was part of the quantum idea. We did a big meeting in March and told people all about quantum, and we named this stock among others as good ideas. And then basically, obviously, they were fantastic ideas. So that's why we were involved in that. And again, you had a chance to get back in there at 50, and then you could have bought the dip. So that was one we brought to your attention. And again, one of the reasons people subscribe is I bring things to your attention that you might not have on your radar. So it's worth buying a subscription to see what Jim has discovered that might have a setup for some substantial volatility because you can't follow all the stocks any more than I can. That's why I take information in from all sources and then I consolidate it into one report each Sunday night. So that was one in June, and another one was, I think HUT we had at the same time, HUT. And as you can see, similar to result, because again, this was part of the crypto deal. Back in July, we had TER. You guys ever heard of this company, Teradyne? Maybe you haven't. You think it would have been nice to hear about it in July? Would you like to know, hey, Teradyne looks good? Well, it'd be nice to know it at 80 because it's up at 187. Another one from July was INCY, Insight. What was it going on in July? $70. Would it be nice to know that Insight might be a good thing to look at right now? So again, these are in the reports, and sometimes you'll find stocks you're not aware of, and that's worth the subscription and then some. Um, let's go out to August. I already showed you Baidu. We also had Rigetti in August. So what was Rigetti Computer doing in August? Well, in August it was trading at $15. You think that maybe being aware of Rigetti at $15 wouldn't have killed you? What else did we put on there in August? We had Google. Why Google in August? Because it had very low P ratio compared to the other ones. Clearly was in an uptrend. And of course, we didn't know it's going to keep going forever here. But of course, you don't know where anything is going, but you get the idea the trend is up. And if the options are pretty cheap, which they were, it's a place where you take your shot. Now, you can't play ball up here because it's 290 and the options are huge. You could, but it's not my game. You got to know what your game is. My game is low priced options that are going to make a big move, not big priced options that are going to kill me if I'm wrong. Next one in that month. Well, oh, this was a good one. Applied Digital. What was it going for in August? It was going for 12. How about that one? Now that's come back down to where you'd want to take another shot if you're a believer, right? But the bottom line is these guys have got relationships, I think, with NVIDIA and other big companies. And so they have got a business that is very much in demand, as you can tell by the price of the stock. But you might not have ever heard of it. And that's why getting this thing in your inbox on Sunday night is not a negative. And then, of course, we had Newmont Mining in there, which we always have something going with the gold. And you can see in August it was at $70, and you can see it went all the way up to 100. Now it's on the defensive as well. What we're figuring out now is this just a pullback where people are stealing Newmont stock and they're going to put it back above 85 on its way to 120. Is that what's happening, or is this the beginning of the end, or the beginning of a more significant retracement to 70? Very similar to a lot of stocks, very similar to the stock market itself. In September, we had Applied Material. A lot of people didn't catch this one. Why did we have it in September? Because it had a reversion to the mean and it was breaking out. So that means that 180, 170 wasn't a bad time to find that on your list. And then we also had CRISP, which is a biotech. And in September, crisp was very crisp, breaking out at 55 and went all the way up to 80. Now it come all the way back down to the line. It might be good down here or it's on its way to 50. But that is the world of biotech. It's called feast and famine. So you got to be right on the right side of the feast because if you're not, and this is why we don't buy things that have already happened. Because if you bought the 80s because you thought it was going to keep going, obviously you got whacked and you got whacked with a big, heavy premium. Um, So there you go, giving you a little bit of an idea. We're going to be coming up on the top of the hour. I'll give you a couple that I find interesting right now, and they're in the banking area. These things are all coming together on Citigroup. It's not going to stay the same. Options are pretty reasonably priced. I'm expecting something big out of Citigroup. I'm also expecting something big out of Charlie. Charlie, Charlie Schwab. They're all together there. Big party. Can't last. Cops are going to come. When they come, they're either going to break them up to 100, they're going to break it down to 86. I don't think it's going to do is stay the same. So between now and January 16th, I would expect some good volatility out of those two possibly. So keep an eye on that. And then there's a stock I'm looking at just because it's so cheap. It's Hawaiian Electric. Take a look at the 5-year graph. This was the one that got whacked because of the Maui fires. That all joining up here at 11. These options are dirt cheap. I don't know if it's ever going to fill that gap, but it doesn't cost much to speculate that it might. And if it ever does, it'll be interesting. They've got earnings coming out on the 7th, which is Friday. So keep an eye on old Hawaiian Electric, and that might be something for you to take a look at. Is there any other questions you guys have? Because I'll just reiterate what I can do for you. If you don't, let me go through here and see if anybody had any stock you want me to look at real quick. I got about a minute or two to do it. So if you had any stocks you want to look at and get a little idea of what they look like through my eyes, more than happy to take a look. And I'm trying to see what we've got here. You guys might want to keep an eye on some of these stocks. If we're not going to have a big correction, stocks like this are interesting to me. XYZ, because the options are cheap. If we're going to have a big rally, these are cheap options to me. I gave you two right there. Okay. This is how I go to find things. I'm not looking for things that have already happened. I'm looking for things that are going to happen. And if they don't happen, it's not going to cost a fortune. And then I manage the risk of them myself. Okay, so we're coming to the top of the hour. I am going to just let you know that David is going to put up a link, and here's the deal. The deal is we have a options alert service where you get a report every Sunday night in the inbox, and you get a midweek report, which I just sent out today, every week. In addition to that, what you need out there is you need education. So when you buy into a subscription with me, you get a receipt as soon as you hit complete purchase, and you get a master class in the same email. You get your receipt and you get a master class as soon as you buy. The master class is 3 sessions, 6 hours of material. So you got your education thing. Second thing is you need ideas and you need a commentary of what's going on in the world from an informed source. I deliver both of those. I give you ideas and I give you an informed source on what's going on out there. The third thing is the big one, and that's coaching. You get my cell phone number. You text me, Jim, this is Mary. Jim, this is John. I'd like to have a coaching session on Thursday at 2 p.m. so we can go through some of this option stuff slowly and I can understand more about how options work, how I can trade them, how I move the strike prices around and the expiration dates, how I follow the trend, how do I sell, what are my choices when I can sell, and go over all that stuff that in a book or on the quick is never going to work for you. So you get the coaching as well. So that's the trifecta. You get the education as soon as you hit complete purchase, and then you get the other two items. Now, when you hit the link, you'll have two choices. Quarterly is being discounted to only $297. That's 90 days. Annual is the steal. It's discounted from $997 to $897. You're putting up $897 for a whole year of education